Hello, everyone. Today, we're going to talk about monetary policy and fiscal policy and how it affects on the aggregate demand. So, during this chapter, while you are reading the uh, textbook or listening to the lectures, please remember to um, just find the answers for these questions. This section will explore how central banks, for example, Federal Reserve in the US, use monetary policy to influence aggregate demand and the ways that fiscal policy, including government spendings and taxation, affects aggregate demand. We also examine the debate on whether policymakers should actively stabilize the economy or let it just self-correct, let it adjust naturally. Monetary policy is all the actions by the um, we actually earlier talked about this in the monetary system. So the central bank, for example, Federal Reserve in the US, conducts open market operations, adjusts reserve requirements, changes the interest rate on reserves, and sets the discount rate to control the money supply. And fiscal policy is the actions of the government. The government determines levels of spending and taxation, which are going to indirectly influence on the aggregate demand through changes in the G, government spending, and T, the taxation. So we earlier discussed about the calculation of the GDP using the spendings of the individuals, businesses, government, and foreigners, and the government can affect on this government expenditures or affect on each of these businesses and consumers by changing the tax. We earlier talked about these and the topic of the aggregate demand and calculation of the GDP before. Um, okay, let's look at each of those policies with more details and see how they are actually affecting the aggregate demand and how the government or Federal Reserve can use these tools to influence on the economy, to stabilize the economy. Money supply is assumed to be a fixed amount, is assumed to be set by Fed, and we assume that it doesn't depend on interest rate. So it's the vertical line, and we are assuming that the quantity of money that is supplied is not a function of the interest rate. But how they actually determine this, the tools that Federal Reserve is using to adjust the money supply include open market operations, changes in the interest rate that it pays on the reserves that banks are reserving in the required reserve account, changes in the reserved requirement rate, and change the discount rate. Okay, we earlier discussed about these tools and methods that Federal Reserve is using to affect on the money supply. And money demand reflects how much wealth people want to hold in liquid form, in the form of money, a liquid asset, rather than just holding on to um, uh, less liquid assets like bonds, but instead earning some interest. So people decide whether they want to just hold the a liquid asset like money or less liquid asset, but with some interest earning like bonds or any other types of the asset. So money demand um, has a downward sloping curve. If the curve for the money demand is downward sloping, it means that when the interest rate falls, people are going to demand more money. So when the interest rate are increasing, it means that people are going to earn more if they hold more bonds or more assets that are earning some interest. So they're going to demand less money and they are going to hold more bonds rather than money. So households balance balance their liquidity preferences between money and bonds. They decide how much money or how much bond they should hold on to. Now, if we put these two together, money demand and money supply, the intersection will be the equilibrium, just as any other supply and demand function. So, money demand reflects how much wealth people want to hold as money, and money supply is a fixed amount by we assume that it is fixed amount by the central banks. The money supply curve is a vertical line because it's not a function of the interest rate, because the money supply is fixed by the Fed and does not depend on the interest rate. Whatever the interest rate is, money supply is going to be exactly at this point. Okay, so the equilibrium interest rate is determined where the money supply and money demand curves intersect. Okay, exactly this point over here, and it shows the equilibrium interest rate. So the central bank uses monetary policy to shift the aggregate demand curve by reducing the or increasing the money supply. If they decide to reduce the money supply, Federal Reserve could sell government bonds and it will increase the interest rate, or discourage spending and investment, and it will finally lead to a leftward shift in the aggregate demand. On the other hand, so let me show that on the curve. Here it is. So the central bank uses monetary policy to shift the aggregate demand. On the curve on the left side, the curve on the left side shows the money market, and the curve on the right side shows the aggregate demand curve at the economy level. So if the Fed decides to reduce the money supply, they are going to, for example, sell the government bonds, and it will increase the interest rate. By selling government bonds, they are going to just collect all the available money at hands of the people, and all the points on this money supply is going to shift to the left. It will discourage spending and investment. This effect of increasing the interest rate is going to affect on the um, consumption and investment, right? So the consumption and investment will uh, decrease, and as a result, we will see a shift in the aggregate demand to the left. So it's going to affect on these two factors, reducing them, and as a result, GDP will reduce, and the total demand, the aggregate demand, will shift to the left at any given price. So it happens in all the price levels. Okay, if I'm showing only P1 over here, that doesn't mean that it is only happening here. No, at any price level, for example, if you look at this price level, the aggregate demand will shift from this point to this point. You see, and all the points on the aggregate demand curve is going to be shifted to the left. So if Fed decreases the money supply by selling bonds, that is going to result in a shift in the money supply to the left. That is going to increase the interest rate. And because of higher interest rate, people are going to be discouraged to the spending of the people and the spending of the investors or the investment will reduce, and it will lower the spending and investment, and it will shift the aggregate demand to the left, decreasing the output. Okay, you see the output is decreasing, while if we just look at it at the same time with uh, aggregate supply, so let me draw that here. So if we have this aggregate supply, if this was the initial equilibrium, this will be the new equilibrium. So this is going to decrease the output, okay? It is going to decrease the output, and it is going to decrease the level of the prices this level, okay? So once again, just to summarize, if Fed decreases the money supply by selling bonds or any other tools that are considered as the monetary policy, including these four tools: open market operations, or changing the reserve requirements, or changing the interest rate on the reserves, or changing the discount rate. If any of these are affecting on the money supply, where the money supply will be decreasing, that is going to also decrease the aggregate demand. Okay? So the Fed may focus on targeting the federal funds rate instead of um, the like money supply directly, by adjusting the money supply to maintain a target interest rate. The Fed will ensure that the liquidity adjustment will be smoother day by day. So this policy will stabilize the fluctuations in the aggregate demand, and it will stabilize the output. Okay, let's look at a practice question. So for a minute, pause the video and think about these three questions. Okay, think about each scenario and how would you answer, and then for the rest of it, then you can play the video and listen to the answers for each of those. Okay, so assuming that you paused and you are continuing the recording, for each of the events below, determine the short-run effects on output, determine how the Fed should adjust the money supply and interest rates to stabilize output, and let's look at each scenario to determine each of these. Okay, looking at the short run effects and how Fed should adjust the money supply and interest rates to stabilize the output. Let's assume that Congress tries to balance the budget by cutting government spending. So this event would definitely reduce the aggregate demand. Let's look at it on the graph. Okay. So we have supply, aggregate, short run aggregate supply, and we have long run aggregate supply, and we have aggregate demand, real output, and level of the prices. So if Congress tries to balance the budget by cutting government spending, it is going to shift the aggregate demand to the left, okay, let's use AD2, all the points on AD1 will shift to the left, and we will be at this new equilibrium point, moving from this long run equilibrium point to this in a stable short run equilibrium point. So comparing this point with the initial amount, you see that it is decreasing the output and is decreasing the level of the prices. But this is this is not this is just a short time, and the economy needs to be stabilized, the output needs to be stabilized and get back to the long run effect, the long run output level. So the Fed should increase the money supply to reduce the R so they can increase or shift back this aggregate demand to the left. So earlier we discussed that if we allow the economy to self-correct, it will just move this path going down here. But now the economy wants to, the government, the Fed wants to stabilize the economy faster, so they are going to use the monetary policy affecting on the aggregate demand, again shifting back the aggregate demand going to the right and finally going back to the same equilibrium point. Okay, so to stabilize the output, the Fed will increase the money supply if we have the money demand and money supply, interest rate, and quantity of the money. So they are going to increase the money supply. This will decrease the interest rate, okay? Decreasing the interest rate is gonna affect on the consumption and investment, and it will increase the aggregate demand, okay? With a reduction in the R, it will increase both of these, shifting the aggregate demand back to the long run point, okay? Let's look at the second scenario. Stock market boom increases household wealth. All right, let's first look at what happens to the output. So we have level of the prices, we have real output, real GDP, we have long run aggregate supply, short run aggregate supply, and aggregate demand. This is the stable point in the economy, but now because of this stock market boom, this event will shift the aggregate demand to the right. So you're gonna just think of all those 4 steps that we earlier discussed. First, we are gonna look at the event. Is it affecting on the aggregate demand or aggregate supply? How it is going to shift the aggregate demand or aggregate supply, in which direction. And then in the third step, we're going to look at the short run effect of this change, which is an increase in the output and an increase and the level of the prices in this particular example, okay, it will increase the aggregate demand, shifting the aggregate demand to the right. Okay, all the points on aggregate demand at any given price will shift to the right, and the new equilibrium will be at this red point over here. Let's call it point A. And comparing point A and point E, the initial equilibrium, you see that the output has increased and the level of the prices have increased as well. But this higher inflation needs to stabilize. The Fed or the government needs to find a way to affect on the aggregate demand. And one of those tools to reduce this, to stabilize this economy faster and faster than the pace for the self-correction. So the Fed is going to reduce the money supply. Quantity of money, and they are going to reduce money supply so they can increase the interest rate. With an increase in the interest rate, we're going to see that consumption and investment are decreasing, and aggregate demand will shift to the left, going back to the um, equilibrium point. So to stabilize the output, the Fed should reduce the money supply. They should just use the monetary policies that are reducing the money supply, and as a result, it will increase the um, interest rate, and it will reduce the aggregate demand by affecting on the consumption and investment of the people. Let's look at the third scenario. Okay, so we are in a stable situation in the economy, and we have long run, short run, and long run aggregate supply, short run aggregate supply, aggregate demand, level of the prices, and real GDP. So, and we are at this equilibrium point that suddenly war breaks out in the Middle East, and it causes the oil prices to soar. So this event will reduce the aggregate supply because oil price is used as the input and used as the resources to produce goods, so it will affect on the aggregate supply, shifting the aggregate supply to the, excuse me, shifting the aggregate supply when the oil prices increase. We're gonna see this aggregate supply shift to the left, and this is going to cause a stagflation. Level of the prices are increasing while the output has been decreasing. So the government needs to stabilize this situation. What they are going to do, they are going to, let's assume that they want to use a monetary policy to stabilize this economy. Okay, so we have money supply, we have money demand, quantity of money, and the interest rate. Okay, so to stabilize the output, the Fed should increase the money supply. So we have lower interest rate. Okay, with lower interest rate, we're going to see that consumption and investment will increase, and it will shift the aggregate demand to the right to this point of long run. Okay, so this happened so because the Fed wanted this to get to this long run equilibrium, long run level, or the stable level, faster than just allowing the economy to self-correct. So because of that time processing, because of that fast um y- like the goal of the Fed to do this faster, they use the monetary policy and they shift the aggregate demand. The effect of that monetary policy is going to be to shift the aggregate demand to the right, although we are getting back to the natural rate of output, but we are also experiencing a permanent increase in the level of the prices. So using this policy resulted in the permanent inflation rate. Okay. All right. Now that we talked about the effects of monetary policy, let's look at the fiscal policy and let's see how what fiscal policy is, how it influences on the aggregate demand. Fiscal policy affects the aggregate demand through government spendings and taxation. An increase in the government spending or decreasing the tax amount will shift the aggregate demand right. Okay, will shift the aggregate demand to the right, and decreasing the government spending or increasing the taxes will shift the aggregate demand to the left. Now let's look at um, some of the examples. So when government spending is increasing, the multiplier effect will amplify the impact on aggregate demand. We will see how, but that's why this example is called as multiplier effect. Okay. So assume that the government buys $2 billion of military trucks from Oshkosh Corporation, and now we want to see what is the effect of this increase in the spendings of the government. This is an increase in the amount of the G. So because G increases by $2 billion, the aggregate demand will shift. So short run aggregate supply, aggregate demand, long run aggregate supply, price, and the output. And we're going to see, because of an increase in the aggregate demand, because of increase in the level of the government's spending, we're going to have aggregate demand to shift to the right. So Oshkosh's revenue increases by $2 billion, okay, distributed to Oshkosh's workers. So this G is an spending that the government is spending on, for example, education, public employees, or building some highways, all those public, or for example, on the security, these are all public expenses, all government spendings that they are salaries or wages for the people who are working in those sectors. So anyone who is working to build that road or highway, who is working in the school, who is working and say in the security sections, the security department of the US, those people are paid by the government, and when this payment is increasing, okay, this increase in G is going to be actually affecting on the income of those people, right? So those people are going to have experience an increase in their revenues by the same amount, by just $2 billion. But when you receive this $2 billion, you have two decisions: whether to spend it or hold on to it, whether to spend it or save it. So you either consume it or save it, right? Either consume or save. You have these two options. Okay, so this $2 billion is distributed to Oshkosh's workers as their wages, or that is paid as the profit or stock dividends to the owners of the businesses. So these people will consume or save this money, okay? Um, and this is going to affect when part of it goes to the consumption, we're going to see that aggregate demand shifts to the right further, okay? So it even goes further to the right. So you see, this government's expenditures not only shift the aggregate demand, they also have a multiplier effect by affecting on the consumption of the people. We're going to talk about the real life examples on Tuesday, how, for example, in the case of COVID, in the case of the government spendings during the COVID, and we will see the similar results on the real data. Okay, so a $2 billion increase in the government expenditures will initially shift the aggregate demand to the right by $2 billion. It will shift exactly equal to $2 billion. But then this $2 billion is paid as the income and salary and the dividend to the people, and they are going to either spend it as the consumption or save it. The part that goes as consumption, it is again shifting the aggregate demand. But this is not exactly equal to $2 billion because there are some people who are saving that money instead of spending it. Okay, that is why we call this as multiplier effect. The multiplier effect is the additional shifts in aggregate demand that result when expansionary fiscal policies increase the income and thereby increases the consumer spending. Okay, now let's look at the changes in the tax. Sometimes we might experience a tax cut. Sometimes the government decides to cut the taxes for specific groups, and it will increase the household's take-home pay. So when you are paid an amount of money, part of it is paid as a tax on the salary, tax on income tax. It's paid to the government. Okay, but when the government decides to have tax cuts, part of that tax stays in your in your payment, in your income, and you get that, and your income will increase. Your disposable income, the income that you have access to, that will increase the money that you already have. And households will respond by spending a portion of this extra income. Okay, so assume that you were receiving this much income in the past, and part of this was going to the government as tax, but now the government says, um, let's reduce the tax to only this much, okay, this green area. So you will see that this black part is added back to your income, to your disposable income that you had earlier. Okay, so you have more money to spend, and more spending means more demand of goods and services, and it will shift the aggregate demand to the right. The size of the shift is affected by the multiplier and crowding out effects. Okay, um, so the size might not be exactly the same as this tax cut amount. Um, Sometimes these tax cuts are permanent, sometimes they are temporary. So when they are permanent tax cuts, they're going to have a large impact on the aggregate demand. But when they are temporary taxes, people know that this tax cut will end at some point, so they might decide to save part of this tax cut for the future spending. Okay, so we're going to see that in the case of the temporary tax cut, the effect on the aggregate demand is going to be a small amount. Hey, but just to let you know, uh, this is something that we earlier also talked during the class. These fiscal policies can also affect on the aggregate supply. So what we had here, it was mainly focusing on the effect of the taxes or government expenditures only on the aggregate demand, but it could also affect on the aggregate supply. People will respond to these incentives. A tax cut, a reduction in the rate of the tax gives workers incentive to work more, so it might increase the quantity of goods and services supplied, and it will shift the aggregate supply to the right. Okay, so at the same time, a tax cut not only shifts the aggregate demand to the right, okay, so if we have this long run aggregate supply, aggregate demand, and aggregate supply, this not only the tax cut brings some extra money back as an income to the hands of the people, they are going to spend more. It is going to shift the aggregate demand to the right. At the same time, this gives the workers an incentive to work more, so it might even um, increase the aggregate supply and shifting the aggregate supply to the right as well. So we will have this new equilibrium point compared to the previous one. Okay, so people who believe this effect is large are usually called as supply siders. And among the economists, a group of people believe that this effect is very large, and they are called as siders. Okay. Uh, on the other side, the other hand, the G is also another factor that could affect on both aggregate demand and aggregate supply at the same time. For example, government increases the spendings on the roads. So when we have better roads, it may increase the business productivity. Um, it will be easier, for example, to um, just move the goods and services between different markets. It will be easier, cheaper, faster, which will increase the quantity of goods and services supplied, and it will shift the aggregate supply to the right. So this effect is probably more relevant to the relevant in the long run. It takes time to build the new roads and put them into use. So that's why the effect of this G on the aggregate supply is mainly relevant to the long run case, and it affects on the long run aggregate supply. Okay, so let's summarize the monetary policy and fiscal policy, and we will talk about real life examples on next session. We will discuss together on Wednesday, and on next week, we will talk about more real life examples with more graphs together. So this topic will be much more easier to understand. But in summary, we try to connect all the dots that we have learned earlier. So we learned about aggregate demand, we learned about aggregate supply, we learned about monetary system, we learned about the actions of the government, how tax and government expenditures are decided by the government. And now we are connecting all those dots together to see when the economy um, just gets out of the stable level of the stable amount of the economy in the long run, how the government can speed up the process of adjusting the situation, stabilizing the situation, because allowing the market to self-correct, allowing the market to get to the long run equilibrium point, it is time consuming. So the government sometimes, depending on the situation, decides to use the monetary policy or fiscal policy. The monetary policy is any using any tools that increase the money supply, which will reduce the interest rate for any given price level, and it will stimulate the investment and spending, and the aggregate demand curve will shift to the right. Fiscal policy is the changes in the government purchases, increasing in the, for example, an increase in the government purchases or a cut in the taxes will shift the aggregate demand curve to the right. So when the government alters these spendings and taxes, the resulting shift in the aggregate demand can be larger or smaller than the fiscal change. Okay, let's talk about more details and more examples on next week and next Monday. So, and that will make this topic much more understandable when we are talking about it in person. All right, have a great weekend, and don't forget to um, look at the announcements and do the homework. All right, see you soon.